Gentlemen,
How are
Howdy.
you?
good to see you.
Good to see you guys. So what do we have on the agenda for today?
So, what I've been finding myself in the same conversation about is single stock concentration. And what I mean by that is oftentimes, not always, but oftentimes, it's the executive works at a publicly traded company, is compensated in stock in their publicly traded company, has the option to buy more stock of the same publicly traded company, and that position itself becomes a significant percentage of their overall net worth. So,
Right. So
top of the
just
topic.
I guess what one of the common themes that we hear about a lot in investing, and we like to talk about is diversification, right? Not putting all of your eggs in one basket. Own investments from multiple companies versus just a single company. But if you are owning two, you may own multiple companies, but have a large portion of it concentrated in a particular company is what the issue is here, is that you're not properly diversified.
Well, I mean, we cage it as an issue, right? But it's actually the reason they got in the conversation with us in the first place many times,
Right.
right? Because the stock has been so successful and it's grown so much, it it's a good problem, right? But effectively, our perspective is it's a problem. But when you look at a company, let's say it's grown by 20% over the last 10 years, year over year, that's exploded the person's net worth. They also may work at that company, so they're going to know a lot of the key decision makers and probably think highly of them. So that concentrated wealth is what put them in a really good financial position in the first place. So while I agree, Skylar, when you're saying it's an issue, that's often very hard to untangle because the issue is the thing that made them financially successful in the first place.
And also that's the what is aligning their interest with the interest of the company is having that ownership.
Hmm.
Yeah, and the first topic there is the difficult conversation of, hey, concentrated investment, like concentrating in one place, made you rich or wealthy, whatever term you want to use there. But Skylar, when you're saying diversification, so it'd be concentrated risk makes you wealthy, diversification keeps you wealthy.
Yeah.
Okay.
Which is oftentimes the when we're coming into the conversation.
And I find that it's been helpful to discuss how to wean yourself to that purely diversified, uh, whether we call it portfolio, whether we call it balance sheet, where develop a plan on how you're going to divest from this concentrated position. And if you work there, from my standpoint, what I've used in the past is, that is one of the largest pieces of that concentrated stock is that you work there. And then you have that stock in whether it's an S&P 500 fund, whether it's held direct, or whether it's held through the retirement plan um, compensation schedule at that employer. So you need to use the fact that that your income is derived from that company as also further concentrating your position in that stock.
Yeah, you bring up a good point, the S&P too, because one in particular I was talking to, the company had grown in value to the point where it was the largest company, one of the largest companies in the S&P 500. So almost by definition, if your company has grown to that level and that size, there's been tremendous success,
Mm-hmm.
right? But then if you're buying the S&P 500, you're not necessarily getting the full diversification because you're still owning that security under the hood of the S&P. So a way, Greg, your point of divesting it. So two things that we often talk about there is one, if we're buying or rebalancing or trading the stock, you're going to have tax consequences. Where you will not have tax consequences is within a 401k or an IRA. So the conversation I was having was, hey, I don't, whatever we buy in the IRA or the 401k, I have opinions on what we should do, but my strongest opinion is it shouldn't be that employer stock where we have a significant amount elsewhere. Not because I don't like the stock, but because we can trade in the IRA and the 401k without incurring tax consequences, and we can essentially buy other areas of the global marketplace.
Mhm.
So that's, to me, the first one. The second is when I'm meeting somebody there or working with somebody, if they're doing any charitable giving, tear up your checkbook. You're not giving checks anymore. You're giving shares of that stock. So by giving the share of the stock away, we're accomplishing, Greg, your point of divesting ownership in that company, and we're doing it without realizing the tax consequences associated with selling the stock. Because if it's a gift to a charity, it's not subject to capital gains tax.
And I want to double down on that idea. We've done this with another client family where we gifted client, mom, dad, gifted stock in kind to daughters who are in a much lower income tax bracket. Daughters sold the stock. So that's another way to divest. If annual exclusion, gifting, unified credit, gifting is part of the goal of the client family, we can also do it that way. And if the family tree goes long enough, you can do that with grandkids. And it's another effective way to try to minimize if you're holding that stock in a taxable account, to your point, Joe.
Yeah, giving up control is a tough one with that, but that's a good, tax planning strategy to think moving it down a generation, both from an estate tax and a capital gains or income tax situation.
Right.
But in a lot of cases, you got to let go of the control there.
True.
So,
True. All right, a lot of good strategies. Let us know if you are dealing with that, or somebody that deals with highly concentrated stock position, and happy to go through the pros and cons and all the different options.
good to see you guys.
Take care.
Yeah.